Real estate versus stocks, which builds wealth faster? Let's talk about one of the most debated questions in the world of money and wealth building. Real estate versus stocks. Which actually builds wealth faster? For decades, investors have argued about whether buying properties or investing in the stock market is the best path to financial freedom. And today, we're going to break this down in detail. This is Smart Dollar Mindset, where we help people achieve financial freedom with smart money habits and investing. If you've ever wondered whether you should buy a rental property, put your cash into index funds, or maybe even do both, this video will give you the clarity you've been looking for. Setting the stage. Building wealth is about more than just making money, it's about growing it in a way that compounds over time, provides security, and creates the freedom to live life on your terms. Both real estate and stocks have proven to create millionaires. Both have unique advantages. And both have pitfalls that can destroy wealth if you're not careful. Imagine two friends. Alex decides to invest $50,000 into real estate by buying a small rental property. Jordan takes the same $50,000 and invests it into the stock market, primarily through index funds. Who's going to build wealth faster? The answer depends on several key factors we're about to unpack step by step. Step 1. Understanding real estate wealth. Real estate has historically been one of the most reliable wealth builders. The U.S. housing market has appreciated at an average of 4 to 6% annually over the long term. But appreciation isn't the only way real estate creates wealth. When you buy a rental property, you have multiple income streams and wealth building levers working for you. Appreciation, the property value increases over time. Cash flow, monthly rent covers expenses and ideally leaves a profit. Mortgage paydown, tenants are essentially paying off your loan. Tax benefits, depreciation, deductions, and even the ability to defer taxes through 1031 exchanges. Leverage, the ability to control a large asset with a small down payment. Let's take Alex's $50,000 investment. Suppose Alex buys a $250,000 rental property with a 20% down payment. Over 20 years, if the home appreciates at just 4% annually, the property could be worth more than $547,000. Meanwhile, renters have been paying down the mortgage, leaving Alex with equity of perhaps $400,000 or more. And along the way, he collected cash flow. This is the power of real estate. You're using leverage, other people's money, and tax incentives to grow your wealth faster than inflation. Step 2. Understanding stock market wealth. Now let's look at Jordan's $50,000 in the stock market. If invested in a broad-based index fund like the S&P 500, the historical return is about 10% annually before inflation, or around 7% adjusted for inflation. At a 10% growth rate, Jordan's $50,000 investment would grow to about $336,000 in 20 years. And if Jordan consistently added money, say another $1,000 a month, the results would be even more powerful, growing into millions over time. Stocks build wealth through capital appreciation, stock prices rising over time. Dividends, regular payouts from profitable companies. Liquidity, the ability to buy and sell quickly without major transaction costs. Diversification, exposure to thousands of companies worldwide through index funds. Compounding, reinvesting dividends and growth multiplies wealth over decades. Jordan doesn't need to deal with tenants, repairs, or property taxes. His wealth grows quietly in the background, as long as he stays invested and avoids panic selling during downturns. Step 3. Speed of wealth building. Real estate versus stocks. Here's the million-dollar question. Which builds wealth faster? The answer depends on leverage and consistency. Real estate allows you to accelerate wealth because you're controlling a large asset with a small amount of money. That's why someone with only $50,000 can buy a $250,000 home. The appreciation on that $250,000, not just the $50,000, builds wealth faster than stocks alone. But stocks compound more smoothly over time. They don't require the constant effort and management that real estate does. Stocks grow automatically through reinvestment and diversification. Let's go back to Alex and Jordan. If Alex's property value grows, and rents increase, his wealth might outpace Jordan's in the first 10 to 15 years. But if Jordan is consistently investing monthly into index funds, compounding will catch up and surpass Alex, especially if Alex doesn't buy more properties. Step 4. Real-life examples. Look at countless millionaires. Many built their fortunes through real estate, especially those who scaled up to multiple properties. A landlord with 10 rental properties, each appreciating and cash flowing, will see massive wealth growth. On the other hand, Warren Buffett became one of the richest men alive almost entirely through the stock market. His strategy? Buying high-quality companies, reinvesting dividends, and letting compounding do the heavy lifting. There are also hybrid examples. Many wealthy people start with real estate to leverage their small savings into bigger assets, then diversify into the stock market to enjoy the liquidity and compounding. Step 5. Risks and pitfalls. Real estate comes with risks. Every decision carries weight. A single vacancy or unexpected repair can tip the scales. Investors must constantly navigate these challenges to safeguard their assets and future. Investors must remain vigilant and proactive. In summary, successful property investment requires a thorough understanding of market dynamics, cash flow management, and prudent financial strategies. By addressing these issues head-on, investors can not only protect their investments but also create opportunities for growth and sustained profitability in the long run. Stocks also have risks. Market fluctuations can trigger fear, leading investors to react impulsively. Those quick decisions, often driven by panic, can undermine years of prudent investment. Achieving financial stability requires a thoughtful approach, coupled with a well-rounded investment portfolio to safeguard against unpredictable market shifts. A diversified portfolio can help mitigate risks effectively. Emotional investing may cause individuals to overlook critical market fundamentals. By understanding market dynamics and maintaining composure during turbulent times, investors can cultivate a resilient mindset, ensuring their strategies align with long-term goals. Wealth building becomes a steadfast journey, where patience and informed decisions prevail over fear, leading to a prosperous financial future. Step 6. Which should you choose? The right choice depends on your personality, skills, and goals. If you like hands-on investing, enjoy managing properties, and want to take advantage of leverage, real estate might be the faster path. If you prefer passive wealth building, compounding growth, and simplicity, the stock market might be the smarter route. For many, the best strategy is both. Use real estate to create cash flow and equity, and stocks to build long-term compounding wealth. Final thoughts. When thinking of wealth building, it's crucial to acknowledge the importance of setting clear, achievable goals. Are you aiming for a comfortable retirement, funding a child's education, or simply growing your wealth? Defining your objectives helps to tailor your investment strategy. Creating a budget that allows for savings and investments provides a strong foundation to weather economic storms. This means allocating resources toward both stocks and real estate, depending on your comfort and preferences. Diversification is a powerful tool that can lead to stability in times of market volatility. By continuously educating yourself on investment opportunities and trends, you ensure that your strategy remains dynamic and responsive. Embrace the journey, and remember that every step taken toward those financial goals counts toward your long-term success. While both pathways have their merits, the key lies in your ability to remain disciplined and focus on long-term outcomes rather than short-term gains. Wealth building thrives on patience. In conclusion, true wealth is not solely about choosing the right investment, it's about your perseverance and commitment to a well-defined strategy. Stay the course, embrace challenges, and let time and consistent effort work in your favor for lasting financial prosperity. At Smart Dollar Mindset, our mission is to help you achieve financial freedom with smart money habits and investing. Whether you choose to grow your wealth through real estate, stocks, or a blend of both, what matters most is that you start, stay consistent, and let time work its magic. If you found value in this video, make sure to subscribe to Smart Dollar Mindset, because we bring you strategies, examples, and insights that help you move closer to financial independence.